folks. It's Dave Burrows. It's Wednesday afternoon. It's time for Tuesday afternoon, time for our barometer readings webcast. I want to thank everybody for jumping on. We're here in the heart of summer. We're in the heart of earnings season. We're learning some things about where the tariffs are going. It doesn't feel like the middle of summer. Things have been busy, but as always, we want to kind of take a bird's eye view of what's going on in the market and just sort of revisit some of our basic theses and see what, if anything, is changing. Of course, one of the great things about this job is I get up every morning and wonder, what's going to be under the tree. It's always interesting. There's always new information. And it's, always a challenge to remember that while there is news of the day, there's 87 other things the market cares about that may or may not be changing. And so new information is just a new piece of the puzzle, and we have to see how the market reacts to it, how it absorbs it. It's always interesting to me how in a bull market, pretty much all news gets read as good news. Even bad news sometimes gets read as good news because maybe it means inflation would be cooling or the Fed might be more likely to lower rates. So this week we had a lot of information come on the EU tariffs and on the tariffs in Japan. It's funny, I think back to the first week of April when all of the tariff information dropped. And it was a pretty scary time, I think, for a lot of folks because it was an upset in the world order. But it just shows you that you can't look at the news of the day as being the only thing, because by the time you figure out that things aren't as bad as you thought, market's way higher. And so I just want to revisit that. Here we are, in a structural bull market that's been going on since 2013 in the US. If we put it under a microscope, since 2013, the market's up 309%. It's been a very robust rally with big corrections along the way. Most recently, of course, in April, as we came down and tested that 200-week moving average. But, now we are basically at new highs. And had we just decided that the news was too bad to put money to work and things were too scary, we would have missed one of the great rallies off the lows that I've seen. So, we have to take new information as it comes. You have to have a process to make your decisions because emotionally, it's too easy to get bearish. The other thing, of course, is the most bearish people in the media sound the smartest because they're the skeptics, and there's not so many wealthy skeptics. If I look at the S&P since the October low, we made a series of higher highs and higher lows. We're sitting here on the SPY at 628. We're just above the highs from early in the year, and market's been marching its way higher. We're above all the moving averages, all the things that we would want to see. And now we're getting more information. So we're at about the height of earnings reports, and they're not so bad. Sales growth on average up 4.7%. Earnings growth up 8.2% on the quarter. Certainly better than what was expected coming in. Sales have come in about 2.5% better than expectation. And earnings just about 7% better than expectation. So we're always following revisions. And then the question is, how does the market how do companies actually report relative to the revisions? So this is kind of the stuff that we look at. What you've got here is the revision trends for a number of different quarters. So in blue were the revisions for the first quarter of 2025. And as we got to the end of the quarter, revisions really ramped going through the earnings period. Wasn't bad as people thought. If you look in orange, the earnings revisions for second quarter, which of course are what we're seeing right now. And as we've been going through the quarter, well, analysts are revising up their estimates. So the question is, The expectation is earnings are going to be better for the third quarter, but will we see revisions go higher from here? Of course, the market's telling us that it believes actually that earnings are going to come in a little bit better. And of course, on this quarter, they have. Now, over the last few weeks, markets chopped around a little bit. Percent of stocks over the 50 days been about stagnant, but the percent of stocks trading above their long-term moving averages continually move higher. If you look at the NASDAQ 100, again, making new highs and above all the moving averages. But one of the tells I think is interesting is it's not everything. The equally weighted S&P, where we equally weight every one of the 500 components, has as of yet not made a new high. It's darn close. We're back at the highs. I think that's a positive. We know that bullish percent, or the percent of stocks in uptrends, has been around 50%, and it continues there. But if we look below the surface, smaller and mid-sized companies not participating to the same degree. I put this up the last couple of weeks. The Russell 2000 is still in a series of lower highs, even though it's rallied a long way off the lows. Now, another way to look at breadth is, okay, US market is one market, Canadian market's another, what's happening globally. And I do think it's interesting that the global stock index, the either the S&P or the MSCI All World Index ex-US, is making new highs steadily. These are monthly bars, and we're marching higher. So that means a lot of countries are showing strength. The Eurozone, we got a little more information about tariffs, and each of the last 4 months has made higher highs. Germany, Italy, Spain, I don't have to go through all of them. But, as time has gone by, this has been an evolving story. And of course, it looks like the reciprocal tariffs will settle in around 15%. A little while ago in June, thought perhaps it would be all in about 11%. Of course, there's some exemptions and some higher tariffs depending. But again, I always go back, how's the market reacting to the news? When the initial news of tariffs hit, we had a really negative view of how things might come out, but we're starting to figure out that maybe it's not going to be as bad as we had thought. And even still, tariffs make it difficult on certain companies, and we have to pick our spots. But market's hanging in pretty well. Japan, we have new information, and the topics hit a new high this week against the news on tariffs. So that's one of the factors driving the market, tariffs. But valuation is another one. Interest rate policy by the central banks is another one. Profitability is another one. A lot of factors. But the upshot is global markets around the world are breaking out to new highs after years and years of underperformance. And, a secular bear market looks a lot different than a secular bull market. So when you come out of a secular bear market and into what is likely a secular bull market, you want to have some exposure. And so we've been busy building more global exposure as we go along, and not because we think the US market will do poorly, but there's opportunities in these other markets. So, the Asia 50 index, 50 largest companies, led by companies like Taiwan Semiconductor and Alibaba and Tencent and Samsung, marching higher relative to the S&P, outperformed better than 83% of the companies in the S&P 500 over the last 52 weeks. Some of the Latin American countries doing well also. But the upshot is global stocks, ex-US, are performing for the first time in a decade, and that's a positive thing. So as more information comes out, they continue to perform well. So this is looking less and less like it's sort of this one-shot wonder of strength for a year out of 15. It's more likely something that is persistent. And even EM, or emerging markets, are now joining the rally. And again, that's a different opportunity set. I've mentioned many times that TSX trades more like global stocks, and month by month we're working way higher. Here we are, the end of July, and you go back to things like people saying, well, sell in May and go away. Well, that has not been the case this year, and we have had I think, pretty good support for that view. So global stocks over the last year outperforming US stocks. When that happens, it tends to happen for years. TSX is doing the same thing. Our global fund, I'm really pleased, is behaving really well. It's up a little over 40% since inception versus the all world index up 29. And it's supported by the fact that some of the sectors that are leading are sectors that do better in a more inflationary environment. 30-year yields continue to look higher. I know that if you look at the very granular short-term chart, bonds have bounced a very little bit over the last 5-6 weeks, but we're really still trading below all the moving averages that are declining, and the bond market's been in a bear market now for over 5 years. So we'll see if that changes. But one of the things that I watch, and not everybody in my team agrees on this, so we have to see information unfold, is if we look at the history of inflation cycles, we're at about the point where you tend to see a second wave, as we did in 1939. 1939, we did in 1910, you did in 1972. We'll see. But something worth watching, because the bond market, it might help explain why the bond market isn't rallying with relatively low inflation data. The other clue that we have is we have commodity prices continuing to firm up. Again, these are monthly bars. So we're trading basically at new highs. Gold has been consolidating over the last 12 weeks. But it's acting okay, and we're headed into August, which tends to be seasonally a decent month. Central banks around the world continue to accumulate, and we're seeing it now at the private investor level. Silver acting very, very well. Copper continuing to act well. Commodities relative to bonds, behaving quite well. So, in general, we think, things continue to march along. Now, I'm going to just change my slide here for a moment. Excuse me. See if I can do this properly. Give me just a moment because something's not showing properly. On the screen. There we go. Okay, so and I think it's still not showing me. Oh, it's just showing the right slides. Okay, there we go. So aggregate gold versus the aggregate bond market continuing to act pretty well. Stocks versus bonds continuing to act pretty well. Commodities versus the equal weight S&P, continue to behave pretty well. So we continue to lean toward a more inflationary view of the world and things that would be hedges against inflation. Now, we've been watching how the various asset classes are behaving on a relative basis. And we've seen that commodities, continue to be quite strong. International equities on a relative strength basis come in next. Domestic equities come in behind, and cash behind that. So currency in general, not providing much by way of return. Fixed income is about the weakest. So in the end of the day, the US dollar, I think, is something that we have to watch, and it's weakening for the first time in a decade. And from that level, it really supports risk assets. When the US dollar starts to back up, it tends to go on for a while. So we don't need to go through all the currencies this week, but we will say that global government bonds are outperforming treasury bonds, and with valuations relatively lower on other developed markets than the US, you can understand maybe why US equities are behaving pretty well. Sorry, global equities behaving pretty well. Bitcoin continues to kind of march along, trading very near the highs. So we go back and revisit where should we be targeting? We're trying to find market leadership. Now, we're watching for change all the time, and we are prepared to play defense if we see sort of breadth start to weaken. But the goal is to focus on the sectors and asset classes that are seeing net inflows, and then find securities that are good getting better to try and express our view. We're always hunting for areas of the market that are showing expanding breadth. And we're trying to find companies that are good getting better to populate our view. And then that's the portfolio list that we're trying to manage. And if we were to see breadth start to contract, we start to get a little bit more cautious. Okay, so how are we doing across the board? The breadth indicators and the long-term indicators continue to improve. So that means a broad cross-section of equity markets around the world are seeing expanding breadth. The percent of stocks trading above the long-term moving averages continues to get better. Hard to get bearish on US stocks when the percent of stocks above the 200-day or long-term moving average is now trading where it was at the highs for the market in December before the tariff sell-off. The same thing's happening in Japan. 75% of companies in the TOPIX, which is 1,500 companies, are trading above their 200-day moving average. This is the best level we've seen in a long time. Now, under the surface in the US, small caps have been doing okay, and I mentioned they haven't taken out the highs from earlier in 2025 or late 2024, but it's getting better. But I will say that small caps relative to the S&P 500 have been weakening. So it tells you that you have to sort of focus in large caps. And when we look at the percent of small caps that are in uptrends, it's only 36%. And that's been rising since April, but nowhere near what we're seeing like in the NYSE at closer to 66% of stocks in uptrends. So let's go back and revisit leadership. The XLF is continuing its march higher. Hope I'm sharing this screen with you. Let's see if I go back. Here we go. So the XLF is making new highs. We've talked about this now since really the beginning of this bull market in 2020. Banks relative to the S&P 500 are trading very close to relative new highs, and we see it in the investment banks in particular. So you got Santander trading near highs, and the Eurozone financials continuing to improve. I will point out that the KIE, which is the insurance ETF, has been seeing weakening relative strength, and companies like Berkshire behaving a little bit poorly. Fairfax today jumped to a new high. So this is not reflecting the strength in Fairfax today, but it traded up through 2,500 and is making absolute and relative new highs. Industrials continue to behave constructively, as are the aerospace stocks. We own GE Aerospace, we own Raytheon, we own Howmet Aerospace, we own Axon. This whole group continues to perform really well, and the power generation companies continue to perform well. So financials, industrials, nothing changing here. On the golds, gold is consolidating, but the gold stocks performing really well. Agnico Eagle today traded very close to a new high. They report their earnings tomorrow. And on a long-term chart, looks as though it's still relatively early days in what could be a multi-year bull market. Kinross also has their earnings tomorrow, trading close to new highs, and Wheaton Precious Metals trading very strong. So the materials continue to behave the right way, copper producers, and certainly the uranium stocks. The mining ETF, which includes base metals, gold and silver producers, and steel stocks, this month made the first new high since 2012, led by companies like Cameco. On energy, another group that would be a hedge against inflation. We've talked about the fact that we've been consolidating here for weeks, but we are seeing the leaders start to break out. Imperial Oil over the last 2 weeks has taken out highs and is seeing nicely rising relative strength. Now, what's a common characteristic between all these resource producers and the industrials and the financials? They're all companies that are generating significant free cash flow. They're all companies that have very manageable debt levels. They're all companies that have been returning capital to shareholders through share buybacks and dividend growth. So this theme of focusing on companies that generate cash and that can return it to shareholders is clearly leading the market. So early days, but we think that we're in a new bull market in these areas. So other groups, communications have been strong over the last couple of years. Relative strength waning a little bit here. We've got a bunch of companies to report earnings over the next couple of weeks. Technology as a group has had a nice rally off the lows in April. It's been sort of levered to some of the bigger names. If you look at the semiconductor group, still unable to make a high like they did back last July. But having said that, relative strength has come up a lot. Internally, in the NASDAQ, breadth has come off a little bit, so we're watching that. But the semiconductors in general are behaving well. And NVIDIA is probably the poster child for the strength. They've got another 30 days before the earnings report. It's just been marching its way higher and certainly has had no problem making new highs. And neither has Broadcom, which is performing really well also. So groups that haven't been performing well, is there anything new going on here? Consumer in general continues to lag. There are some standout names. We own a couple in Canada, but in general, relative strength has continued to be weak. Consumer staples continue to be weak. The healthcare stocks, they just can't get going, whether it's pharmaceutical or healthcare providers. The real estate investment trusts, a user of capital, they are relatively underperforming. And utilities, while the price chart is getting better, the relative strength continues to be weak. So this is an interesting market. It's a market where high beta or higher economic sensitivity clearly is continuing to lead low volatility or the defensive cohort. So there's lots of things to worry about. We worry about tariffs. We worry about earnings revisions. We worry about all kinds of things. But at the end of the day, we have to focus on the things that are attracting capital because money isn't stupid. It finds its way to the things that treat it the best. Since the middle of March 2023, we've seen really nice progress. Our equity portfolio is up 48% over the period. The income portfolio is up 40%. The global portfolio is up 62%. The balanced portfolio is up 20%, and this is versus the bond market at +6%, and the equally weighted S&P up 39%. So there's always going to be things to worry about. But this, I think, is one of the greatest graphics. This is the breadth distribution chart by sector going back to the April the 9th. So just as a reminder, for all of the sectors that are shown in this column, they had between 0 and 14% of companies within their group with constructive price patterns. In other words, almost nothing. As you move to the right, the sectors had stronger breadth at that point. So precious metals makes sense. It was one of the stronger groups. But look at the financial groups, regional banks, big banks, insurance companies, waste, that's industrial, steel, it's materials, building materials. These were the strongest groups at the worst point in the market. I always care about what is it that holds up best during a decline. Let's fast forward to May 30th. We went from the average sector at 19% of stocks in uptrends to the average sector having 45% of stocks in uptrends, and they're moving to the right. Strongest groups at that point: aerospace, insurance, banks, machinery, Wall Street, semiconductors, computers, steel, economically sensitive groups. Let's fast forward to today, 2 months into the sell in May and go away syndrome. Well, a higher percentage of stocks in uptrends, 51%. And we're moving to the right. The strongest groups: aerospace, banks, semiconductors, steel, regional banks, builders, precious metals, machinery, capital markets, banks. Weakest groups: healthcare, right? Some of the consumer groups. So the market is constantly digesting information, and then it reacts accordingly. If we waited to hear the tariff news, we would have missed a giant rally over the last couple of months. So breadth to me has always been a guiding light, and it helped us into these names. In the banks, JP Morgan, Morgan Stanley, the Canadian banks, which are behaving really, really well, Santander in Europe, Fairfax, which made a new all-time high today against a group that's actually been weakening. In aerospace, GE Aerospace, Howmet, Embraer, Raytheon, all of them performing like champs. In energy, GE Vernova making gas turbines and turbines for nuclear power, Cameco. In oil and gas, Canadian Natural Resources and Imperial Oil, big, prolific dividend payers and return of capital to shareholders. Agnico, Wheaton, and Kinross. We entered these at a time when people in general hated gold stocks after a year of a decade of underperformance. Metals companies: Hudbay, Freeport-McMoRan. And of course, there's technology: NVIDIA, Broadcom, Lam, Microsoft, Google, Meta. Right? These are world-beating companies. They continue to perform well. We've got to have some exposure. When we look at the overall exposure in the portfolios, it really hasn't changed much. Financials are our largest weight. Industrials, the next largest weight, and that's been growing. Technology, which we've been adding to in pieces, but there's other things to do. Materials are doing a great job in providing return, and we'll see whether the oil companies can get going like CNQ and Imperial, but certainly acting better. On the defensive sectors, still not much to do. Nothing really in real estate, very little in utilities, almost nothing in healthcare out of Boston Scientific, which frankly is trading near new highs. Consumer staples continue to be light, and consumer discretionary in general, about a third of the index weight. Overall, we're trying to make sure we're generating a rising stream of income to offset a rising cost of living. In the income portfolio, it's almost all dividend growth companies. If we look at the 1-year dividend growth across the portfolio, it's 12.14%. So we're obviously growing income a lot faster than inflation. I know there's things to worry about, but at the same time, there's some things that to be really optimistic about. If the US strategy ultimately results in lower overall tariffs globally, then maybe we get more and more efficient in trade. Certainly, the credit markets are not overly afraid. The excess return bond investors are asking of corporations versus governments has been contracting. That's the bond market saying it's not concerned about credit risk. Volatility is solidly within sort of bull market range and has been falling, which means, volatility control funds can continue to put money to work. And if there's low volatility in general, it helps private investors to get more comfortable getting money into the market. So look, we're coming out of July with a positive return. Now, in years where you came out of July with a negative return, with a negative return, you wound up, it tended to be that you had a weak return into the end of September. Coming in with a positive return. So markets near highs. We're coming out of the reporting period. If we look here on the chart, the 27th of July, it means that corporations are restarting their buyback programs. Earnings have been progressing well. If it's time to get more defensive, we'll see it in the breadth data and we'll start to do something. But frankly, where the market gets to the end of July with a nice positive number, it tends to be that it carries through the rest of the year. So we're going to watch the estimates. We're going to watch the remainder of the tariff data come out. We know that it's going to continue to change. And we're going to watch the way the market reacts. And if we have to, we'll get more defensive. But in the near term, it continues to look pretty darn bullish for both commodities and for equities. And there doesn't appear to be a lot of need to hedge against disinflation or deflation with fixed income. So let's see if there's any questions to take. Lawrence Knight, are we still adding to positions for Fairfax? Sorry. If Fairfax earnings are good and we continue to increase the size of the position, it's becoming a pretty big position, Lawrence. It's the biggest position in the firm and has been now for several months. Performance has been pretty darn good. Let's just see if I can share the chart. Here we go. So close today at $2,512. It's very close to new relative strength high. I will say that with the insurance group as a whole weaker, this is the insurance ETF, you can see making a relative strength new low. We probably aren't adding to it at this point. Even versus Berkshire, BRKB. Berkshire's coming off as well. So look, Fairfax tends to trade at a discount. That discount's getting squeezed out. They do look as though they're growing a little bit faster than other property and casualty companies and generating a lot of dividend income. So we'll continue to be there. Another question is, another example would be adding to Santander. But Santander continues to truck along and it's still trading at a significant discount to US banks. So yeah, for sure, we would continue to do that. Robert, can we comment on the price action of copper lately? So his question has to do with, is it inversely correlated to the strength of the US dollar, or is it principally correlated to the health of the economy? Robert, you have to look at it both ways. Certainly we've had a little bit of a bounce in the US dollar. I still consider it to be solidly in a downtrend. If you look at the point and figure chart on the US dollar, it clearly continues to be in a downtrend. See if I can just pull that up for you quickly. So this is US dollar versus the basket of world currencies at 110 in January. Pulls back, lower high, lower low, lower high, lower low, lower high, and it continues to be in lower lows and lower highs. So this little bounce would be typical, bouncing back to the point where it broke down. My guess is this is probably headed down toward 90, but we'll see. That would probably be pretty constructive for copper. But frankly, copper is correlated to the economy. It's correlated to the fact that there has not been a lot of new development of copper mines over the last number of years because copper prices were weak. There's a bunch of factors here, but certainly the dollar is one that doesn't hurt it. Paul, there have been some good positive earnings reports. Commodities and financials are holding up nicely. In the case of where some momentum stocks reported decent earnings, not corresponding to fall through stock price. Okay. So look, you always watch not only what the earnings are, but what the response is to earnings. This quarter, there is certainly more speculation in the market And so as a result, on some earnings reports, even when they came in well, they sold off the next day. As long as they aren't breaking down technically, that doesn't bother us so much. Very often you get a couple of days of weakness, like you do in the banks often in the quarterly reports, but then they find a footing and work their way higher. So it's not so much about the daily trade, it's about whether the price pattern changes and then how the revisions go after the fact. But in general, I think that companies have come through the earnings period really quite well. Um, David asking what we think of Tech B. We think Tech B looks okay. We have Freeport as it is right now. I'd like to own Tech B, but we have Hudbay that has been technically a little bit stronger. Sorry, Hudbay. So, there needs to be some work. Let's pull up the chart. Well, let's look at the US dollar chart. Now, here we go. So, this has got to get better before we can put any money to work here. Higher highs and higher lows, and then it broke down in the month of July. So it's going to take a little bit more work before we can do something here. I guess that's it. I think we've got all the questions. Thanks everybody for joining in. Sorry, it looks like I screwed up the slides for a little while there, but I guess we got it sorted out. If you got questions that we didn't answer today, or you're wondering about something, don't hesitate to reach out. I'm happy to jump on the phone at any point. I know that our portfolio manager is also very happy to talk about specific companies if you've got questions. Otherwise, send them in to us and we'll answer them for you on next week's webcast. Hope everybody has a great week. Enjoy summer.